All right, so the first question we had was quick study 1-7, and it says that you're supposed to record these transactions based upon the accounting equation. So I'm going to write the accounting equation out here. Assets equals liabilities plus owner's equity. And for the first transaction, letter A, it said total assets of charter company equaled 700,000 and its equity is 420,000. What is the amount of liabilities? So they said assets were 700,000, right?
Yes.
And it said that equity is 420,000. So that means our liabilities are what? 280,000, because if you subtract 420,000 from 700,000 for assets, you'll get 280,000. Good. Letter B. Total assets of Martin Marine equal 500,000 and its liabilities and equity amounts are equal to each other. What is the amount of its liabilities and what is the amount of its equity? So it said that their assets were 500,000, and that is clear cut that if both of these are equal to each other, that means that they are how much each?
250,000.
250,000. Very good. Good on this?
Yes.
Okay. All right, quick study 1-8. It says use the accounting equation to compute the missing financial statement amounts. So for number one up here for company one, we have assets of 75,000. We're searching for liabilities here, and we have equity of 40,000. And if we subtract 40,000 from 75,000, we get what? 30,000? 35,000. Good. Number two, you have liabilities of 25,000 and you have equity of 70,000. 70,000 plus 25,000 equals what? 95,000. So that is the amount of our assets. Company three, you have assets of 85,000 and you have liabilities of 20,000, but we are searching for equity. And 20,000 subtracted from 85,000 is going to give us what?
65,000.
65,000. So that is the amount of our equity. Number two, it says use the expanded accounting equation to compute the missing financial statements amount. So company one, you're missing revenues. If you go from left to right, liabilities, you have 16,000 plus owner's capital of 20,000 equals what? 36,000. And 36,000 minus 8,000 of expenses equals what? How much? 28,000. And the best way for you to find out what the revenues amount is that you subtract 28,000 from what? 40,000, which equals 12,000. And that is going to be our revenue amount. Then for number two, we know ultimately this side needs to equal 80,000. So going from left to right, 32,000 in liabilities plus owner's capital of 44,000 equals what? 76,000. We're trying to find out our withdrawals, right? 76,000 plus 24,000 is what? 100,000. And then minus 18,000? 82,000. Now, you know your assets are 80,000. So 80,000 minus 82,000 is going to equal a negative what? 2,000. So this is your withdrawal amount. Everybody got it? Still writing? Let me know when you're done. This will be in the classroom as well, in the module 1 folder as well, just in case you have to refer back to it. Good? Okay. The next one, quick study 1-10, we're supposed to record all of this based upon the accounting equation. And really, this is the expanded one. So they give you the accounts. We have assets equal liabilities plus owner's equity and they've given us the accounts. So they have cash, which we know is an asset, right? Accounts receivable, and that's it for assets. And then liabilities, we have accounts payable, and that's it for liabilities. And for owners equity, we have capital minus withdrawals, right, plus revenues minus expenses. All right, so letter A. The company completed consulting work for a client and immediately collected $5,500 cash earned. So what two accounts are affected here? Cash and what else? And revenue. And cash increases or decreases? Increases by 5,500. And capital increases or revenue increases or decreases? Increases by 5,500. Letter B. The company completed commission work for a client and sent a bill for $4,000 to be received within 30 days. So what two accounts are affected here?
Accounts receivable.
Accounts receivable and revenue. Because you haven't received any cash. You performed this work and you're going to send out a bill to be paid later. So accounts receivable increases by 4,000 and revenue increases by 4,000. Letter C, the company paid an assistant $1,400 cash as wages for the period. What two accounts are affected here? Cash and expenses. So cash increases or decreases? Decreases by 1,400. And expenses increase or decrease? Increase by 1,400. Letter D. The company collected $1,000 cash as a partial payment for the amount owed by the client in transaction B. So this is the client that put it on accounts receivable back in transaction B. Now they're paying $1,000 cash towards that balance. So what two accounts are affected? Cash and accounts receivable. Does cash increase or decrease? Increases by 1,000. And accounts receivable does what? Decreases by 1,000. Very good. Letter E. The company paid $700 cash for this period's cleaning services. What two accounts are affected?
Cash and expenses.
Cash and expenses. So we're going to decrease cash by 700.
Yes.
And we're going to increase our expenses by 700. So now we can total up our columns here. Our total for cash is going to be what? 4,400. Our total for accounts receivable? 3,000 for a total amount of assets of what? 7,400. Accounts payable, we can separate this off. Accounts payable, 0, right? Capital, 0. Withdrawals, 0. Revenues,
9,500.
9,500. Expenses,
2,100.
how much? 2,100. So when we subtract 2,100 from 9,500, we get what?
7,400.
And we balance, right?
Yes.
Everybody has this?
Yes.
Did somebody say no? Okay. All right. So quick study 1-12 says indicate in which financial statement each item would most likely appear. I for income statement, B for balance sheet, E for statement of owner's equity, and C, F for statement of cash flows. So assets, what statement is this going to appear on? Balance sheet, good. B, cash from operating activities.
Statement of cash flow.
Cash flows. Withdrawals.
Equity.
Statement of owner's equity, good. Equipment.
Balance sheet.
Balance sheet, because equipment is a what? Asset. Expenses.
Balance sheet.
Income statement. What's on the income statement? Only revenues and expenses. Liabilities.
Cash flow.
Balance sheet.
I don't want to mix them up.
G, net decrease or increase in cash.
Okay. Income.
Net decrease or increase in cash. Cash flow statement.
Oh.
Revenues.
Income statement.
Income statement. And total liabilities and equity.
Balance sheet.
Balance sheet. Good. Good to go? Okay. Let me know when.
So we don't miss 15.
Ready to go? All right. So the next one was exercise 1-15. And it says preparing an income statement. On October 1st, Ebony Ernst organized Ernst Consulting. On October 3rd, the owner contributed $84,000 in assets to launch the business. On October 31st, the company's records show the following items and amounts. Use this information to prepare an October income statement for the business. So what goes on the income statement? Revenues and expenses. So some of these we care nothing about, right? We don't care about cash. We don't care about accounts receivable because that's an asset, right? We don't care about office supplies. What else don't we care about? Land. What else? Equipment. What else? Accounts payable. What else? Investments. What else? Withdrawals. Is that it? The rest of this we need, don't we? To complete an income statement? Yes. So we know they gave you a hint here that your net income is supposed to come out to $2,110. So we list revenues first. And our revenues are what? Consulting fee earned.
Yep.
And that is going to be 14,000. And next we need to list our expenses. First expense is rent expense. For $3,540. $550. Salaries expense, $7,000. Telephone expense, $760. Miscellaneous expense, $580. Check the math. Net income should be what? Good to go? Somebody said no? Got it?
Yep.
All right. The next part of this, which was exercise 1-16, they asked us to do a statement of owner's equity using that same information. So what's on the statement of owner's equity? Beginning capital, what else? Withdrawals and net income. You remember that was 2,110 from the previous statement. Now remember in the previous statement they told you how much was invested into the company as far as assets? Right, but because we don't know what was invested, we can't really use that as our beginning capital amount. So we have to assume that beginning capital was zero. So we do Ernst, beginning capital, zero. And then we're supposed to do what to net income? Add. So you add net income, which was how much? 2,110. So that's going to give us 2,110 as the balance. And then you're going to subtract what? Withdrawals, which were how much? 2,000. Which means ending capital is going to be what? $110. Oh wait. I missed something. That's what I had. I had that thought in my mind. And you guys have to work with me, but between this ADHD and this bipolar disorder, sometimes I'm a little, okay. All right. Up here, because I almost forgot, or I did forget. Along with net income, you also need to add what? Investments. What were their investments? 80 what? 84,000. So now this new amount. What's this new amount now? 86,110.
110.
Now less 2,000 of withdrawals means that we have ending capital of what?
84, 110.
Okay. Phew. Ready? Or no? No? Okay. So the last thing we need to do is prepare what? Balance sheet, exercise 1-17. The balance sheet only has what?
It has liabilities, assets,
Okay.
equity.
So we're going to start off with our assets, which are what? Call them out to me.
Assets.
Cash,
Cash.
and that was 11,360.
Accounts receivable.
Accounts receivable, okay,
Land.
14,000. Remember that order of liquidity? Office supplies. Which is 3,250. What's next? Office equipment. Which is 18,000. Okay. Land. Which is 46,000. Is that it?
Invest.
We included the investments where? On the last statement.
Oh.
So how much are our assets here? What you get? 92,610. And over here we need to do our liabilities. What liabilities do you have? Accounts payable, which is 8,500. Have anything else? Looks like that may be it. And then your equity. What equity do you have? What's the only equity that you have? Capital, right? Capital. That's all you got. Which was how much? Which means that 8,500 plus 84,110 equals what?
92,600.
92,610. So it's going to be liabilities and owner's equity. And we balance, right?